Are you ready for what comes next? Michael Burry, the man who predicted the 2008 crash successfully, is sounding the alarm again. This time, the staggering rise in global debt could set off the next financial crisis. Not to mention the US national debt alone right now is $35 trillion. Burry warns that it's only a matter of time before the bubble bursts, with the possibility of widespread economic downturns, job losses, and inflation, leaving people facing financial ruin. So, how can we weather the storm? In this video, we are going to break down Burry's strategies and discuss how you can safeguard your portfolio against potential market volatility. Let's get started. Understanding Michael Burry's warning. Michael Burry's recent warnings about market trends have captured the attention of investors and analysts alike. He has pointed to several key economic indicators that suggest a potential downturn. Among these indicators are rising inflation rates, increasing interest rates, and a slowdown in consumer spending. Burry emphasizes that these factors could lead to a significant correction in the stock market, urging investors to be cautious and reassess their portfolios. The potential impact of Burry's warnings on investors cannot be overstated. His insights encourage a re-evaluation of risk exposure, prompting many to consider defensive strategies. Investors who heed his advice may seek to diversify their portfolios, increase cash reserves, or explore alternative investments that can withstand market volatility. Ignoring these warnings could result in substantial losses, especially for those heavily invested in high-risk assets. Burry's track record lends considerable weight to his current warnings. His successful prediction of the 2008 housing market crash showcased his ability to analyze complex economic data and identify trends before they become apparent to the broader market. This credibility has made him a trusted voice in financial circles, and many investors look to his insights as a guiding light during uncertain times. As we explore the implications of Burry's warnings, it becomes clear that understanding his perspective is essential for making informed investment decisions in today's unpredictable economic landscape. If you are enjoying the video, hit the subscribe button and comment down your thoughts. If you want to explore money-making strategies, click the link in the description to start your financial journey. Historical context. Lessons from the past. Throughout history, there have been numerous instances where market warnings were issued, only to be ignored by investors, leading to dire consequences. One of the most notable examples is the 2008 financial crisis. Prior to the collapse, several economists and analysts raised alarms about the unsustainable growth in housing prices and the proliferation of subprime mortgages. Despite these warnings, many investors remained optimistic, believing that the housing market would continue to rise. The eventual crash resulted in a global recession, wiping out trillions in wealth and leaving millions unemployed. Another significant event was the dot-com bubble of the late 1990s. Analysts warned about the overvaluation of tech stocks, yet many investors were swept up in the euphoria of rapid technological advancement. When the bubble burst in 2000, it led to a massive market correction, with many investors suffering substantial losses. These historical events underscore the importance of heeding market warnings and understanding the cyclical nature of economies. By analyzing past behaviors, investors can develop more informed strategies that prioritize risk management and diversification. For instance, during periods of economic expansion, it may be wise to gradually shift towards more conservative investments as a hedge against potential downturns. Learning from the past can empower investors to make better decisions today, ensuring they are prepared for whatever the market may bring in the future. Portfolio protection strategies. In uncertain times, safeguarding investments become a top priority for many investors. One of the most effective strategies for risk management is diversification. By spreading investments across various asset classes, sectors, and geographic regions, investors can reduce the impacts of a poor performing asset on the overall portfolio. This approach helps to mitigate risk as different assets often react differently to market conditions, providing a buffer against volatility. Another essential component of a well-rounded portfolio is the inclusion of defensive stocks and sectors. These are typically companies that provide essential goods and services, such as utilities, healthcare, and consumer staples. During economic downturns, these sectors tend to be more resilient as demand for their products remains relatively stable. By incorporating defensive stocks into a portfolio, investors can enhance stability and potentially generate steady returns even in challenging market environments. Additionally, maintaining cash reserves is crucial for navigating uncertain times. Having liquid assets on hand allows investors to take advantage of market opportunities as they arise, such as purchasing undervalued stocks during a downturn. Furthermore, exploring alternative investments such as real estate or even commodities can provide additional layers of protection. These assets often have low correlations with traditional stocks and bonds, offering a hedge against market fluctuations. By implementing these portfolio protection strategies, investors can better position themselves to weather economic storms and safeguard their financial futures. Real-life stories. Investors who adapted. Throughout financial history, there are inspiring stories of investors who successfully navigated market downturns by implementing strategies similar to those advocated by Michael Burry. One notable example is John Paulson, a hedge fund manager who famously shorted the subprime mortgage market before the 2008 financial crisis. By recognizing the unsustainable nature of housing prices and the risks associated with subprime loans, Paulson positioned his fund to profit significantly when the market collapsed. His foresight and willingness to act on market warnings allowed him to achieve remarkable returns, demonstrating the power of adaptability in investing. Another example is Cathie Wood, the founder of ARK Invest, who has focused on disruptive innovation. During periods of market volatility, Wood has maintained a long-term perspective, investing in sectors like technology and clean energy. While her strategies faced criticism during market corrections, her commitment to her research and adaptability allowed her firm to rebound strongly as the market recovered. This highlights the importance of having a clear investment thesis and the ability to pivot when necessary. These stories underscore the critical role of adaptability and foresight in investing. Investors who can recognize changing market conditions and adjust their strategies accordingly are often the ones who thrive during turbulent times. By learning from the experiences of successful investors like Paulson and Wood, others can gain valuable insights into how to navigate market volatility and protect their investment effectively. Expert opinions, financial advisors weigh in. As Michael Burry's warnings about potential market downturns gain traction, financial experts are weighing in with their insights and analyses. Many advisors, along with the volatility of Burry's concerns, particularly regarding rising inflation and interest rates, they emphasize that these economic indicators can significantly impact market performance, making it essential for investors to remain vigilant and informed. Advisors often highlight the importance of conducting thorough research and staying updated on macroeconomic trends to make sound investment decisions. When it comes to Burry's strategies, there is a general consensus among financial professionals regarding their effectiveness. Diversification, a key tenet of Burry's approach, is widely endorsed as a fundamental strategy for risk management. Financial advisors stress that spreading investments across various asset classes can help mitigate losses during market volatility. Additionally, the inclusion of defensive stocks and sectors is frequently recommended as a way to provide stability in uncertain times. Experts also encourage investors to consider their own risk tolerance and investment goals when evaluating Burry's strategies. While his insights can be valuable, it's crucial for individuals to tailor their approaches based on personal circumstances. By incorporating expert advice into their investment decisions, viewers can enhance their understanding of market dynamics and better navigate potential challenges. Ultimately, staying informed and adaptable, as advised by financial professionals, can empower investors to make more confident choices in an ever-changing financial landscape. If you want to know more about the path to prosperity, check out the video here and see you there.